So you've done a DSCR loan on a single family residence, you've talked to the lender, you know how to pencil out the numbers, you know how to understand if it debt coverages or not, but what if you're looking to purchase a property in the 2 to 4 unit space? Does that qualify now moving into commercial? Good news, the answer is no. On today's episode, we're going to cover 3 things. Why 4 rent checks is better than 1, why a fourplex still sits in the residential DSCR space, and how to run the math without mixing up the DSCR and the cash flow. Let's get into it. I'm Ryan Marks. Welcome back to another episode of the SCI Mortgage Podcast. We're just here to put out great content for those of you who are self-employed or looking to build your real estate portfolio and don't quite fit into the big bank lending box. Jumping right into number 1, 4 rent checks is better than 1. If you have a single family residence and your tenant moves out, you've immediately moved from 100% occupancy to 0. You are now responsible for making that mortgage payment, including the taxes and insurance, while you work to locate another tenant. Whereas if you have a 4 unit and 1 tenant moves out, you are still at a 75% occupancy factor. That doesn't completely eliminate the risk, but it definitely reduces it as you are still receiving cash flow on the other 3 units while you're waiting to secure another tenant. Or more importantly, what if you purchase a property that needs a little bit of TLC work so that way you can increase the rents to fair market value? You could work to rehab one individual unit at a time so you can bring the property up to fair market rent to capitalize on the full investment. Whereas if you have to move the tenant out or you don't have a tenant while you work to rehab the property, you're not collecting any rent until you have a tenant in place if you have a single family residence. The other thing you have to understand is the vacancy risk also helps with the DSCR, because if you're feeding more rent into the same loan, more units traditionally equals more income on the property. A 4-unit property will likely produce more rent combined against the mortgage payment versus a single family residence with 1 tenant. Number 2, the box does not change from residential to commercial until you hit 5 units and above. This is the part that most investors miss, that in the 1 to 4 unit space, they are all still treated as a traditional residential loan as it applies to the DSCR financing. That means you still have the opportunity to go as low as 15% down payment if it debt coverages. Spoiler alert, most of the time you're going to have to put that 20% down payment, but in addition to that, it has a much lower barrier of entry for qualifying credit score, and often 0 reserves are needed. As soon as you add that 5th unit, we do offer DSCR loans up to as high as 12 units that are considered residential, but you're going to have to qualify with a higher credit score, a minimum of a 25% down payment, and you are definitely going to need reserves for the property. Pricing on these types of loans is also traditionally heavier, although they both offer the ability to utilize that prepay lever, which we've talked about in other episodes, which can further drive down the interest rate in order for you to maximize the positive cash flow. So bringing us right into number 3, where it's important that you crunch the numbers to make sure this property cash flows on debt coverage, and why the power of having a 4-unit property really adds up versus having a single family residence. We're going to take an actual example from a client who recently closed on a fourplex at a $650,000 purchase price. He put the standard 20% down payment, giving him a loan amount of $520,000, and his gross rents were $6,600 or $1,650 per unit. If you use 1.25% for the annual property tax rate and an average of $150 a month for insurance, you will see that on a loan amount of $520,000 at an interest rate of 6.75% fixed, this program was utilizing a 1-year prepayment penalty to drive that interest rate down. So keep in mind when you are looking into interest rates, or we're talking about interest rates, that we go over the gamut of everything from no prepayment penalty all the way up to a 5-year prepayment penalty if your market allows for it, and make sure that we crunch the numbers to see what the difference is and really find that sweet spot. So for this example, we used a 1-year prepayment penalty in order to get that interest rate of 6.75% on a 30-year fixed, and the all-in payment including the taxes and insurance, was $4,199.79. So you can clearly see from this example that we're receiving $6,600 a month in rents on this fourplex, and the monthly payment being just under $4,200, is debt coveraging over 1.5%. This is a very good performing property for this customer, and obviously he was very happy to close on it and put it in his portfolio. But let's break this down a little further. If you take the example of a fourplex versus a single family residence, and you lost a tenant in this example at only having 3 tenants occupied, it would still debt coverage at 1.18, meaning that you're still positive cash flowing out the door, only having 3 tenants on this example. And that is exactly why having a fourplex gives you a lot more flexibility, lowers the risks, and more often than not, gives you much more positive cash flow than just having one single family residence receiving one individual rent. And if that tenant were to leave, immediately your vacancy drops from 100% to 0. Now, aside from receiving more rent on a fourplex versus a single family residence, there's a lot of other built-in safety nets that you get living within this residential space. For example, you still have the ability to vest in an entity like an LLC or a corporation. You can take a 30-year fixed mortgage. You can even utilize programs if you want to maximize positive cash flow while you work to bring the property up to fair market rent. There's loan programs available where you can have a 40-year interest only, meaning the loan is fixed, but for the first 10 years of this 40-year interest only product, you have the ability to make interest only payments. So if you were to take an interest only payment based on this particular scenario, you would further positive cash flow. And more importantly, if you needed it to debt coverage, you'd have the ability to do that. In addition to the 1 to 4 unit space, the barrier of entry still stands at a standard 1 for the debt coverage ratio, meaning the amount of your payment with taxes and insurance and any applicable HOAs would equal the amount of rent you're receiving and the property with debt coverage. However, if it does not, there is a lot of creative alternatives available in order to still receive financing for a 4-unit property, just like a single family residence. If this property hypothetically did not debt coverage, meaning that it was under 1, it was 0.99 or even 0.75 or less, there are no ratio DSCR loans available where you don't have to have any rent, or regardless of what the rent is, you could still qualify on a no ratio loan. Typically that's reserved for a 25% down payment or greater. Or a little pro tip, we have programs available where you can essentially use your assets and turn that into income in order to make the property debt coverage. So let's say you had a 401k with $200,000. You would leave that asset wherever it's currently being managed. You would simply provide that statement. We'd use a formula to divide out those available funds and essentially turn it into rent and apply it to your property in order for it to debt coverage. All of these additional programs and levers are available when you're living within that 1 to 4 unit residential space. Once you go to that 5 and above, you're a lot more limited on what you can qualify for, the down payment, and the credit and reserve requirements. This is why I love the fourplex property so much as it pertains to investment properties when utilizing this DSCR financing. So just to recap, fourplex equals 4 rent checks, lower vacancy factor, still qualify within limited guidelines with no documentation, use just your rent, whether the property is currently vacant or occupied, and calculate that simply by dividing your current fully amortized payment, PITI, divided by the rent, and that will give you your debt coverage. For more great tools and resources available, like utilizing our DSCR or our bank statement calculators, head on over to scimortgage.com, where you can also get in touch with us. If you have a fourplex that you're eyeing in front of you, we'd love the opportunity to pencil out the numbers to see if it's a good fit for your portfolio. And until then, remember to let your income work smarter, not harder. We'll see you on the next one.